All right, we could be in for a third day of losses. 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, there's unappetizing news in fast food after an E. coli outbreak is linked to McDonald's Quarter Pounders.
And the tired man of Europe is warning about another Trump presidency. We'll have a conversation with German Finance Minister Christian Lindner in just a few minutes.
And a lost decade. Goldman Sachs calls for annualized S&P 500 returns of just 3% over the next 10 years. David Kostin, the man behind that call, joins us later this hour. Let's take a look at where markets are trading. 30 minutes until the bells ring. As Matt said, we're poised for a third straight day of losses. Haven't seen that in quite a while, but the S&P 500 currently down about 0.4% as earnings continue to roll in. Same thing, too, if you take a look at the NASDAQ 100 down about 0.4%. Tesla coming after the bell today. And then you take a look at the bond market. If it was quiet yesterday, it's selling off today, currently higher by about 3 basis points on your 10-year Treasury yield. We are firmly above 420. Matt, that is the highest level since July.
All right, another Goldman Sachs call from last year. I believe this was a Jan Hatzius call. If Trump wins, we'll see the Fed hiking rates. Well, I've got a chart here that shows the betting odds of Trump winning in blue, as well as the U.S. 10-year yield in yellow and the dollar index in white. And you can see that the yields keep rising as the chances of Trump winning the presidency does as well.
We will certainly talk about that Trump trade. Today, we're going to talk about some earnings as well. Boeing shares now lower. It reported a steeper loss per share than Wall Street had anticipated, but it's only down about 1%. We'll talk a lot more about that throughout the hour. McDonald's down now more than 7%. Shares are down as an E. coli outbreak linked to an onion distributor has left one person dead and 10 people hospitalized. We'll talk more about that as well. Starbucks down now almost 4%, 3.8%. They suspended guidance for 2025. The new CEO, Brian Niccol, is grappling with declining sales in the U.S. and China. Tough way to start out, Matt.
Yeah, absolutely. I mean, we've had some up and down earnings stories this morning. You've got a beat and a raise at Coca-Cola, AT&T disappointing. But really, the big earnings stories came out after the bell last night. You mentioned McDonald's, you mentioned Starbucks, and those are dragging on the index today.
Big time. McDonald's down mightily this morning. We knew that things were turbulent over at Starbucks. McDonald's, of course, coming out of nowhere with this E. coli outbreak. Pretty shocking to see shares down almost 8%. Pre-market, really taking the market by surprise.
And it's interesting, the bulk of the earnings are next week, of course, but then we do still have Tesla to look forward to within a number of hours. And you have to wonder, with the sour mood you've had in the market this week, what's going to start to turn the page? Because a beat, in many cases, it doesn't seem like enough for investors to hang their hat on with valuations still this high.
Yeah, we got, 7 hours to go until Tesla earnings after the bell. Joining us to unpack all of this earnings news, a lot of it consumer news. Obviously, Coca-Cola, McDonald's, Starbucks. Michael Halen joins us from Bloomberg Intelligence. And Michael, it's really McDonald's that stands out the most to me. 1 dead and 50 sick with E. coli after eating, quarter pounders with a sliver of onion?
Yeah, it was, usually you hear it in lettuce or spinach, but yeah, it's usually a raw product, and it sounds like it came from the onion. Yeah, tragic, man. And this is one of the worst things that can happen to a restaurant chain, right? You want to provide your consumers, a tasteful yet safe product. Really terrible news.
Yeah, absolutely. And of course, I heard you speaking on radio with Tom Keene and Paul Sweeney talking about if you grill the onions, of course, that will help cut down the risk. But it's interesting that we have some blueprints for how McDonald's can manage out of this. You think of Chipotle, for example, obviously dealing with their own E. coli outbreak. Wendy's has had some issues in the past as well. I mean, what is the roadmap here for McDonald's?
Yeah, I think the roadmap is potentially changing the operations. I mentioned potentially grilling onions would kill the bacteria, the pathogens. Also, they're going to have to prove to the consumers and to investors that they're doing what they need to do in terms of food safety. Right? I think they've responded very quick. With the incident yesterday, they've acted swiftly to stop sales of quarter pounders in the area and quickly identified the supplier. operations has always been McDonald's strong point, right? But they're going to have to show some penance and make people comfortable enough to eat in the restaurants again.
While we have you, I want to switch gears, talk about Starbucks for a second here, because it's another prove me story going on. Of course, investors love Brian Niccol, but they don't seem to love the idea of suspended guidance. What did you make of their move to kind of buy him some time there?
Yeah, I think any smart CEO is going to do that, right? They're going to suspend guidance so they have more time to get their initiatives in place, right? You can't turn around the aircraft carrier on a dime, right? You're not going to turn Starbucks around in 3 months, right? So the poor report was no shock to us. I mean, results have been abysmal for the last 2 quarters. We've been writing for a year. That trends were looking pretty bad here. So no, to me, it's Brian Niccol is just like it helps him next year because it's just another easy lap to comp that he's going to get to comp over. So I think this is old news to most investors. I think going forward, it's going to be about what Brian Niccol can do and about some of these management changes he made at the top of China and now with a chief brand officer and moving forward and creating a culture of transparency, trust, accountability, and hard work.
Michael, it's a great point that eventually what we're seeing now with Starbucks will turn into easy comps, but certainly feels like a long road to get there. That is Michael Halen from Bloomberg Intelligence. Meanwhile, let's broaden out here, take a look at futures, of course. We are less than 30 minutes until the bell, and as you can see, we're staring down at a down day. Currently, the S&P 500, the NASDAQ 100, the small caps, they're all lower across the board. And that is our jumping off point to discuss with Bernstein Private Wealth Chief Investment Officer Alex Chaloff, sitting to my left. Great to see you in person.
Thank you for having me.
Let's start with earnings because we've been talking about the earnings reaction, and actually it's been pretty good. The S&P 500 members that have managed to beat earnings are being rewarded by 1.7% on average in the stock market the day after reporting results. At least according to Bloomberg Intelligence, that is the strongest rate in records going back to 2019. But then you take a look at a setup like today, it doesn't necessarily feel like it.
I don't think today is so much about the earnings, even though we're in the middle of earnings season right now. We've got this week with 100 plus, next week with 100 plus, and the third week with 100 plus companies reporting. We're in it. So every day there's going to be some focus on earnings, but the market right now feels more about uncertainty around the election. Where do we go from here? What's fiscal policy? Look at what the 10-year is doing. 10-year doesn't have anything to do with earnings today.
What are you watching with regards to the election? I was just showing a chart that betting odds are rising. And we've talked about the potential flaws with relying on betting odds, but betting odds are rising on the possibility of Trump getting into the Oval Office. And with that, we see the 10-year yield rising. We see the dollar index rising. What have you got your eye on in regards to the election?
Well, it's too close to call. Normally at election time, I'm doing my best just to dodge and play down the middle. Thankfully, I don't have to do much dodging because it really is neck and neck. I think the bond market is voting Trump right now. They're expressing a view that fiscal policy will expand, and that's why rates are moving.
Is that what's going on, though? Because that question is being asked across all media, really, financial media. Is this a Trump trade in the bond market, or is this just a reaction to the economic data that we're getting?
I think it's more about a growth scare than an inflation scare. If you think about what markets have been concerned about over the last couple of years, it's been inflation. Now we've put that behind us, and now the concern has moved to growth. Are we growing too quickly? And rates are clearly moving to respond to that. But look, no matter who wins in a couple of weeks, and when we finally learn who wins in a couple of weeks after that, there's expansion in fiscal policy. Both parties have expressed that. So either way, the 10-year is doing what it should do right now.
Alex, what are you watching on election night? You have really the country on a knife's edge when you think about where people are going here. You see the Trump trade in the bond market, as you said. Are you watching the dollar? Are you watching bonds? Are you watching equities the next day? What moves?
I think, well, I'll be watching Bloomberg on election night, of course.
Thank you.
And listening to it on radio when I go to the kitchen.
As you should.
Thank you. But I think we're going to watch everything. I mean, there's so much vol right now in the market, maybe not expressed in the VIX per se, but the 10-year, you're seeing currency, the dollar's having some interesting moves. And you're seeing some sectors move around, over the last couple of weeks. Quality has really carried it out. People are moving into the low vol space. They want safety. They want security. They're trading for dividend yield. Their hedge funds are de-risking. You talk to the prime brokers and the desks. Everyone's taking down the risk and just saying, not this time. I don't want to be exposed in the wrong way.
It's incredible. 424 on the 10-year this morning. And, you know, Matt, I lose my mind to you at the desk every time we see movements like that. I do. I shake him physically. And so I actually do. And so, Alex, you look at that and you want to ask what the read-through is to the stock market. If rates stay elevated, particularly on the long end, do equity investors get comfortable with that kind of revised discount rate?
I think that we've been living in a 4-handle 10-year for a while, alongside a market that's been premium valued. I'll be generous. And so...
Not too rich?
Not too rich, not too rich. With the earnings growth that we're having, even with a modest slowdown this quarter, earnings coming into the year, the expectation of the S&P was 11.5-ish. Right now, the full year is 9.5%. Next year will be 15%. 26, for what it's worth, is another big number. So the earnings support the multiple where we stand today. But look, it's tricky. It's hard to justify when you plot the 10-year next to the multiple on the S&P. Today's market doesn't make a lot of sense. You got to fall back to earnings. It's all about the growth rate of earnings. And earnings are growing while inflation is dropping.
We are going to talk to David Kostin in just a moment. He's got a pretty bold call that we're only going to see a 3% annualized return over the next 10 years. That's only happened, mind you, when we've had the Great Depression or the oil shock or the financial crisis.
Yes.
Do you see that coming as well?
You know, we've been saying for the last couple of years that returns are going to come down in pure long-only equities, especially in the S&P 500. Our forecasts are very similar to what your guest in an hour will talk about. We're probably closer to 5 than to 3, but it's the same neighborhood. Our expectation is, you know, it's going to be a foot race between investment-grade credit and equities for the next few years. And that's, you know, everyone's panicking. I won't say panicking. Everyone's nervous around the 10-year is so high. Oh, my gosh. You know what that
Sonali is panicking.
I know. There's some
in the morning. She's like,
I have
oh my
no emotions around it.
Sonali, I'm going to tell you to relax. Everyone take a breath. Because if we hang around these levels for a while, we're going to clip this coupon for the next 10 years. Yeah. And so I think that, and if you're at 5 and I can get credit to 5, with some research, I can push 5.5. This is fun. So our bond guys have been in a winter in 2022, and now they're very excited about where we go from here. Our equity guys, they're still focused. They still think they can grind out a little bit of return above and beyond what we talked about. Especially excited about what's going on outside the U.S. We focus on the S&P, but looking outside the U.S., there's real cheapness. There is earnings growth. I'm not going to say anything about what's going on in China because that may be short-lived, but there are really some things to get excited about overseas.
Alex, thank you so much for joining us here in studio. Of course, that is Bernstein Private Wealth Chief Investment Officer Alex Chalov. And coming up, U.S. allies reminding the world of the importance of the upcoming presidential election. We're going to be joined by German Finance Minister Christian Lindner. Joining us next. This is Bloomberg.
All right, we have less than 2 weeks to go until heading to the polls here in the United States, but our allies are reminding us that the outcome is consequential to the whole world. German Finance Minister Christian Lindner, in a speech at the University Club of New York yesterday, called the vote a decision for the League of Liberal Democracies who share our common values. Lindner, who is also the head of Germany's pro-business FDP political party, joins us now on set here at 731 Lex. Great to have you with us. Thank you so much, Mr. Minister. My first question, do you think former President Donald Trump shares those common values?
The Republican Party shares those values, and it's in the best interest of the U.S. To remember that there's one difference between the U.S. and Russia and China and others. The United States, they have allies in the world like Germany, France, and others, and it's in the best interest of the U.S. Doesn't matter who enters the White House, to remember this. Together, we are stronger. And together we are able to maintain the rule-based international order and the multilateralism we all benefit from.
We all work together, but it seems to Mr. Trump and to others that America foots the bill, usually, right? Germany, for the first time, has met its pledged 2% of GDP target for spending, and that is only because of a special 100 billion euro package. Do you need to raise your defense spending more going forward?
We will. As you have pointed out, Trump and his predecessors, they were right. There hadn't been a fair burden sharing among NATO members, but this is the past. Germany reaches the 2% objective of NATO for defense, and we will continue to do so. At the moment,
next year as well, because it
yes.
seems that as this package is spent, you'll be spending far less.
I can assure you, we not only know our responsibilities, we can see the geopolitical reality. There is a new normal. We have to deal with Russia, which has not only attacked Ukraine, but tries to harm the international rule-based order, and we cannot allow this. So this is why we have a change in our priorities, in our policies. We have started with this extra budget of 100 billion euros for defense, but this won't stop. We will continue out of the regular budget from 2028.
I do want to talk about how tariffs would factor into all of this, because of course Donald Trump has pledged 60% tariffs on China, but 20% on everyone else. And you think about the German economy, of course, this month the government cut your GDP forecast for next year. You expect a contraction of about 0.2% instead of growth. That's before tariffs. If tariffs were to pass, if we were to see those 20% levels, how do you even model for that?
We have to find a level playing field and a fair trade agreement among European Union and the US, whoever is in the White House. It's in the best interest to cooperate. I can understand that the US realize that the People's Republic of China is a strategic rival. And I'm not convinced by the trade policies of the People's Republic of China. But we should not forget that we benefit, US and European Union, from our trade relationship. It's not only security, it's economy as well. And so, first part of my answer is diplomacy. We have to talk to each other, whether there are concerns and how we can overcome them. And the second part of my answer is, well, the European Union as a whole and Germany in particular, we have to restore our competitiveness. Germany has been losing competitiveness for a decade now, from year to year. And now we have to focus on our strengths. We have intellectual property, a qualified workforce, a well-capitalized economy, including our SMEs, the hidden champions. But we have structural deficits on the supply side of our economy, and now we are introducing a growth initiative with over 100 measures, from mobilizing labor market to tax incentives for investment and research.
To follow on Katie's question here, though, if Trump were to win the White House, some of these tariffs are very significant. Could you lay out what is at stake for your economy if you do see those go into fruition?
Well, every kind of trade conflict harms both sides. Right. There won't be success for anyone out of a trade controversy between the US and the European Union. So this is why I cannot only answer your question with regard to European Union or Germany. It is not in the interest of the US to follow protectionism. We have to deal together with People's Republic of China. The People's Republic of China is a possible risk for the League of Liberal Democracies and Free Traders altogether. And this is why we should stick together as allies.
I don't know that there are any free traders left in this country. I mean, it's not only Trump putting in these protectionist policies, right? Biden passed the Inflation Reduction Act, which subsidized our auto industry here to the detriment, I would say, of Germany. Do you have plans to subsidize EV sales
No.
in your country? You have
No.
a difficult situation selling EVs, and you're looking at possibly closing down a Volkswagen plant.
Well, first of all, I have my doubts that the fiscal policy of the US can be continued in the foreseeable future. And on the other side, there is a huge amount of taxpayers' money on the table in the European Union. So given the size of our economies, we are subsidizing in Europe already a lot. So compared to the IRA, I think we have no deficit. The competitive disadvantage of the European Union is capital markets union. We have a lack of private sector capital. We have those pay-as-you-go pension systems instead of pension funds. And so this is the area I'm focusing on. And the situation of the German car manufacturers, I can assure you, they are producing the best cars in the world. Doesn't matter whether electrified or combustion engine, and I'm convinced they will be successful even after a phase of transition.
Yeah.
I do not intend to introduce further subsidies. We have to focus on the charging infrastructure. Okay, there are still some deficits to convince people of buying those cars. But the framework conditions for our car manufacturers in Europe as a whole have to be reconsidered. To be very frank, I think the end of the combustion engine in 2035 is not only too early, I think we do not need that date. We should be open for all technologies, and even the combustion engine is possible to be used climate neutral with synthetic fuels.
Yeah, that'll be interesting to see how, especially Porsche, moves forward with that. I want to ask about, you said that you doubt the fiscal situation in this country can go on, and this is something we talk about a lot on this program. What do you think stops the spending orgy that both parties have planned? Is it voters? Is it the bond market? What holds us back?
Well, I'm a supporter of a market-driven development, and so there could be a situation in which the US politics will reconsider whether it's in the best interest of this country to spend so much taxpayers' money for servicing old debt. But I'm not here to give others advice. I can only claim for Germany, we won't follow that path. So we try to modernize our framework conditions. We are introducing structural reforms, but we will keep the stability of our public budget. We will be reducing deficits and debt to GDP ratio.
We thank you so very much for joining us
Thank
here
you.
in studio on your trip to New York. That is, of course, German Finance Minister Christian Lindner. And coming up, less than 4 minutes to the opening bell, we're going to discuss where markets are headed. We have Goldman's David Kostin, of course, out earlier this week with a big call. We're going to talk about it. This is Bloomberg.
We are moments away from the start of trading, and we could be looking at the third down day in a row. Yesterday, we came back up into the green a couple of times near the closing bell, but sunk down to the red for the final trade. And that means we had back-to-back losses. The first time that's happened in 6 weeks, over 30 sessions. And now we could have a triple. Take a look at the opening bell. I think it's interesting. It's not there yet, but do we have it? Are we going to have it? Because I think it's the Liberty. I think that the WNBA champions are ringing the opening bell in New York, but I can't see anything there. It's less interesting at the NASDAQ. There's a biotech company called Upstream Bio, but we haven't mentioned on this program yet that the women of New York won the national championship in basketball, which is pretty cool, Katie. It doesn't, however, save us from a down day on the major averages. What do you see?
That was a very artful segue, and you're absolutely right. You take a look at the screen behind me. There is just red across the board right now, starting with the S&P 500 down about 0.3%, and then it gets worse from there because you have the NASDAQ 100 0.4%, and then your small caps down about 0.5%. We are in the thick of earnings season, but we were having this conversation with Alex Shaloff. This probably isn't earnings related right now, but watch the NASDAQ 100 once, of course, Tesla reports after the bell. Meanwhile, let's take a look under the hood and get back to those earnings because Boeing's new CEO says that the plane maker needs time before it can consider developing a new aircraft. Of course, it reported a third quarter loss per share that was steeper than expected. It missed on revenue, and oh boy, you take a look at that cash burn. You add it all together, shares down about 1.5%, which is pretty contained, Sonali, but this is a stock that's down nearly 40% year to date.
A little less contained here. We are looking at shares of McDonald's down 7% or more as the market opens. This is after that E. coli outbreak was reported linked to its quarter pounders that has sickened dozens of people in the United States, Matt.
Yeah, definitely something, well, I'm going to try and avoid. I also haven't been to Starbucks in a while, and that company pulled guidance for 2025 after sales plunged for a third consecutive quarter. Challenges, I guess you could say challenges mount for CEO, the new CEO, Brian Niccol. The challenges were already there. That's why they brought him in, and this actually frees him up to do a little bit more in terms of a turnaround. Sonali?
And this week, you might remember, Goldman Sachs came out with a note saying that the streak of blockbuster gains for the S&P 500, it might be over. And they say that we'll only see around annual gains around 3% over the next decade, compared to the average 13% over the past decade. And we are joined now by Goldman Sachs Chief U.S. Equity Strategist David Kostin, who led that call. He joins us now. When you think about this call, very controversial, David. And so I am very curious about kind of what the caveat is here. Is there kind of any upside that could be squeezed out of the equity market that is outside of this base case?
So let's talk about the base case for the next year, and then we'll look at the base case for the following 9 years for full year, decade of performance. So the next year, we're looking at the S&P 500 rising around 8%, 9% total return to an index level of around 6,300. And the thought process behind that is the U.S. Economy is growing, inflation's coming down, the Fed is cutting rates, earnings are growing 11% in calendar 2025 and another 7% in calendar 2026. And that sets up with a valuation today of around 22 times earnings, slight compression in the multiple. That is the building blocks to a return in the next 12 months of roughly 9%. So what we focused on in this report was what's the probable total return that an investor should anticipate for the cap-weighted S&P 500 index. And the conclusion was a range of somewhere between -1% and +7%. Midpoint of that is around 3%. What is the driving force behind that thought process and that analytics? Well, there are two issues. The first is valuation. We know when the market trades at a high multiple, a high valuation, that the next 10 years is typically low relative to an environment where, say, the multiple was low at the beginning. You tend to get a pretty strong return in the subsequent decade. So we're sitting here with a cyclically adjusted PE multiple that's different from a forward one-year multiple, based on the cyclical adjusted earnings for the last decade of 38 times. That's the 97th percentile versus, say, the last 100 years. So it's a very, very expensive starting point. And what's new about the analysis is that we also include a variable for concentration. We're in one of the highest concentration markets in 100 years. Top 10 stocks, for example, comprise around 36% of the index. It's an extremely narrow concentration. And historically, when you have a high concentration market, you have a relatively muted return in the subsequent 10 years. Now, valuation and concentration are two different variables. They're not correlated. And so there's two different influences as to why we get a lower, relatively modest return.
Yep.
Now, what are the implications for a portfolio manager? Matt, the way you want to think about this is equal weighted. The equal weighted return is likely to be probably 500 basis points greater. So instead of 3% for an aggregate index, something like 8% for the typical equal weighted index. And so that's the conclusion of the report.
Well, but the concentration is in, I think, very many global champions, right? I mean, you have companies that dominate their spaces globally. Plus, we've got a few that are likely to come on board soon. SpaceX, for example, OpenAI may go public in the next decade. And if I look, David, over the last decade, I actually stole this chart from DataTrek, as I've pointed out before, but the only time that we've had 3% returns has been when we've had catastrophic events, the Great Depression, the oil shock, the financial crisis. Do you expect something like that to come again over the next decade?
No, what we're anticipating is a broadening of the market, the relative performance of the typical stock versus an aggregate index. What we're focusing on is a strategy for how to perform well. When we deal with some of our largest institutional clients, sovereign wealth funds, pension funds, endowments, insurance companies, family offices, when they think about a 10-year horizon, they think about asset allocation, where are the risks? And the idea of a very concentrated market is what tends to be a risk that gets introduced. And that is the emphasis of this report. And that's the thought process, that's the analytics behind it in the model that we built. We look at rates, we look at the economic environment, we look at the profitability and the ROE of companies. And so all of these variables at the index level relative to the typical stock, that's how we get to a conclusion that it's a better strategy, a better return strategy from our perspective with a equal weighted strategy.
Well, David, I want to talk about the cross-asset nature of this call, too, because you say that it's likely that bonds are going to outperform in this environment. But reading through this call, I mean, if you're not calling for a recession here, I assume the Fed doesn't cut rates back to zero. Wouldn't this be a call for cash? Aren't cash yields going to stay relatively high and you don't have any credit or duration risk there?
Well, I mean, there's other strategies. You could look at private credit. You could look at private equity as a potential way of diversifying a portfolio. Relative to right now, the idea of treasuries, 10-year treasuries yielding 4.2%. So if you were to start today and look out with our centerpiece of our, or the central case of our forecast, something like 3%. But if you look at the distribution, look, the idea of being at the high end, there are a lot of reasons why you could be at the higher end of our range, closer to 7%. Matt identified a couple of those. You typically get around 3.5% of the constituents in the S&P 500 turnover every year. So we look out for a decade, you're probably looking at a third of the index. There's going to be new stocks that don't exist today in the index. So there's certainly a lot of variables that could happen. The economy could be growing more rapidly, more slowly than a baseline forecast. Those are their issues. AI, in terms of artificial intelligence, could raise productivity. I mean, lots of reasons why it could be better than our base case scenario, which is why we have a range to the upside and the downside.
You know, one thing that struck me in this note as well is a 1/3 chance that you have the S&P 500 lagging inflation through 2034. What's the role of inflation here, and what is the risk that it could be higher? What if the neutral rate is higher? What kind of impact would that have on equity market returns?
Well, so you think about inflation right now, the TIPS break-evens are around 2.2%, for example. And so based on a scenario where you have a return that could be -1% annualized versus +7%, kind of there's a distribution around that, relatively normal type distribution, the part tail of the distribution would give you a prospect of a return that's less than inflation. That's not the base case, but it certainly is a scenario. When you deal with portfolio managers, they want to think about what are the risks that are introduced into their portfolio. And the argument behind a broadening of the market is an important construct. It's one of the arguments on why mid-cap stocks are likely to do better than the rest of the market in the coming year. They have the best torque to the idea of the Fed cutting rates. They got 25% of their balance sheet is floating rate. So you have the Fed cut rates, they have less interest expense, they have higher earnings, positive earnings revisions drives equity prices. And so those are tactical issues, opportunities in the market. So we think about tactics, we think about strategy longer term, and that's the purpose of writing the report in response to questions from clients about how should we think about the prospective 10-year forward returns in the equities.
Right. David, we don't have a lot of time left. I know I have a question. I know that Matt has a question as well. So let me ask you this quickly. I want to get existential about the business that you're in, because you think back to January, and actually Wall Street strategists on average were expecting the S&P 500 to rise about 2% this year. It's up 23%. And I'll flip the question to you. Is it getting harder to model, to forecast where the index is going to go?
Well, it is challenging because a third of the index is comprised right now of about 10 stocks. That's not just tech stocks. You have some healthcare stocks, Eli Lilly. You've got Berkshire Hathaway's in the top 10 companies, for example. Depends on the day we're looking at. It could be Visa, Broadcom, different constituents, along with the big tech companies that we're all familiar with. And so it's challenging to look at the market that's that component, and you can look at the rest of the balance of the market. So you think about those big stocks. They trade at 31 times earnings. That's a 2.7% or so earnings yield. It's a negative risk premium versus 10-year treasuries. So that's a concern about valuation. And then you have the concentration item that I overlaid. The rest of the market has a positive risk premium versus bonds. And so that's one of the attractive components of why there's a broadening of the market and why we anticipate that to persist.
David, I have an election night question for you. When you get home, put on your slippers, grab a scotch and your pipe or whatever, and you settle down in that lazy boy, right? Click on Bloomberg TV. What are the indexes or the assets, or what are you going to be watching on election night as we hopefully get a clearer picture of who's going to occupy the White House in the next 4 years?
Well, the election is obviously quite close in terms of the polls and things like that. So I think there's a couple things that we look at. First, is there a split Congress versus the presidency? That would suggest there's certain executive actions that can be taken, whether that's respect to tariffs, whether it's respect to certain regulation aspects that the presidency, he or she, could implement. Whereas if there's a sweep on the Democrat or the Republican side, either direction, there are potential legislative aspects. So, Matt, that's sort of the first question I want to think about. The second is we think about, well, what are the impacts of potential tariffs? What would they be? Well, U.S. companies that are selling domestically are likely to outperform U.S. companies that export more to the rest of the world because there could be retaliatory tariffs. So that's one strategy that we might look at. We might look at companies that have that sort of executive authority that you might want to think about. And then we would talk about that with portfolio managers. And there's baskets that we trade on Bloomberg with clients based on those two characteristics.
All right, so it sounds like you have a lot to keep an eye on. We all do, and we really appreciate you taking the time today to walk through that call heard around the world. That is Goldman Sachs Chief U.S. Equity Strategist, David Kostin.
Thanks, David.
Coming up, Boeing CEO is calling for a culture change as workers are set to vote on a new contract tonight. Details next. This is Bloomberg. Well, Boeing reported negative adjusted free cash flow for the third quarter that was worse than expected. And that's, of course, as the struggling plane maker deals with labor, supply, and regulatory challenges under new leadership. Let's discuss now with Bloomberg Intelligence senior aerospace analyst George Ferguson. So, George, we knew it was going to be bad. It was pretty bad. And you had Kelly Ortberg basically asking investors to give him time to right the ship here. How much time is it going to take?
So it took a lot of years to get to this position. So I would expect it's going to take a couple of years to get out of it, right? But I think the challenge here is for Kelly Ortberg to start getting things moving the right direction. I think that that path to moving the right direction is is probably tonight when you see the union vote on the new contract, getting them back to work, having them happy and building quality airplanes. That's the key to the recovery. The 737 is the most important airplane in Boeing's portfolio. It's the moneymaker, the cash generator. So I think that's the most important thing that Kelly's got in front of him. But it's going to take a couple of years to get this company on the right, on the right trajectory.
So a couple years timeline here, but let's focus on tonight. Of course, you bring up the vote. I have to imagine that getting this labor negotiation through, this signed, of course, has to be priority number one. How painful has this strike been for Boeing?
I mean, so far, the machinists have been out for about a month, and from everything I'm hearing from the from out in the field, is that suppliers are still, a lot of them are still building product. They may not be delivering it to Boeing, so it's stacking up on their docks, but they're at least still building it, and so they're keeping their employees, active, making product. Still the skill sets aren't deteriorating. So I would say if we get an agreement today, I would imagine it's a month and a half before they're sort of back to getting the factories rolling pretty decently again. Mm-hmm. So not a lot of damage to the supply chain is what I'm trying to say. Mm-hmm. If this continues to drag on, I think the risk becomes Boeing to conserve cash, just to stop taking deliveries from suppliers, and then you see more pain to the supply chain, and that's the real risk.
There's so much to talk about Boeing, of course, that pending capital raise as well, but I want to switch gears for a moment here because you're watching Spirit shares really surging today, up almost 30%. There's a report in the Wall Street Journal out this morning saying that Frontier and Spirit may revive a deal. It would have to happen through bankruptcy. However, how do you view this? Because you look at just where Spirit has come over the last year, just how much the stock has deteriorated, and what would this deal really mean for both companies if they are able to get it done?
Yeah, it's something I think not totally unexpected. Look, I think in the beginning, when Frontier and Spirit were going to put themselves together, that was a much better, much more natural fit. The airplanes, they both fly the same type of airplanes. They're both ultra low-cost carriers. So to me, again, I thought that was a more natural fit. I think JetBlue stepped in the middle of that because they didn't want to run the risk of having a much bigger competitor. I think there's a surplus of economy seats in the marketplace right now. So if I'm Frontier, I don't want to pay up for economy seats. So I think that's why the thought process is there's got to go through some sort of purge that would get rid of some of the debt. I think they've got to be ready to buy this thing pretty cheap because the value of it's come down pretty significantly since their initial deal. But again, I think the product and the aircraft that they fly, it's all pretty similar, so could be interesting.
George, we thank you so much for your analysis. A lot going on in the airline industry right now. That is George Ferguson from Bloomberg Intelligence. And coming up, the chairman of EQT naming his top worry for the business, it's not higher interest rates. We're going to talk about what he's thinking about next in our Wall Street beat. This is Bloomberg.
The risk that I am most concerned about are the geopolitical risks right now, because you can easily paint a very negative geopolitical scenario, and in such a scenario where the whole logic for trade, for international cooperation, if that goes away, goes back to where we came from, those risks, I would say, is more severe and difficult for us to manage than all the other things.
And it's time now for Wall Street Beat. That was EQT founder and chair Connie Johnson speaking at the company's first U.S. capital markets event in New York. Bloomberg's Annie Berger conducted the interview. She joins us now. And, this is one of the rare private equity firms that is publicly traded, but of course abroad. Mm-hmm. Very curious about their ambitions here in the United States, because what's happening is a lot of these European private equity firms are trying to find a lot bigger of a foothold here.
And it was so interesting because throughout the Capital Markets Day, him and the others kept trying to emphasize, we're Swedish, we're Nordic, we have this very friendly approach. And I asked Connie Johnson, okay, why are we here then? Why are we currently sitting in New York if that is the case? He basically said, look, our two biggest markets right now are the U.S. and Asia. They've also moved their CFO over to the U.S. too. they want to compete with the big players here, and they are getting bigger. They want to do that in a different way. They are listed in Sweden. I asked if he thought maybe that was a mistake and they'd rather list in the U.S. After all, it is more liquid. He stayed with the contention that they were happy to be in Sweden. But look, all you need to do is look at the European markets to understand why they're targeting the U.S. Europe has a problem right now where they are struggling to get investments just into the economy itself. In terms of fundraising, they have a much more plentiful market here in America, not just sort of the smaller wealth management shops of Europe.
You know, I read the story as soon as it crossed yesterday because I thought it was interesting that he didn't put other risks first. However, was he just being human? Was he just saying war is bad and we all agree it's tragic?
Yeah.
Or was he actually talking about, its effect on his business?
I think both. I mean, again, it's hard as a human to look at what's happening at the world and to not be upset with it. But he said, we've gone through this period of high interest rates. We've gone with the volatility in rates markets, and we know how to deal with it. EQT is a great example of this. They have been so active this year. I don't think it's an exaggeration to say one of the most active private equity funds, even though rates are still high. He says, look, we can deal with it. We know how to deal with it. It's the geopolitics that we don't. If we're dealing with multinational countries and they have to trade and trade barriers are getting put up, what does that mean? We were tested and we lived through Ukraine, Russia, but if it happens to a more extreme degree, we're not ready for it.
All right, Danny, great having you on set with us. Thanks so much for joining us. Tremendous interview with EQT. Bloomberg's Danny Berger. You can catch her program every morning at 5 a.m. She gets here very early. Coming up in the next hour, Coca-Cola shares under pressure this morning despite boosting its revenue outlook. We'll discuss the results of the company's CFO, John Murphy. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, consumer companies under pressure, from McDonald's to Hilton and Starbucks. We're going to take a look at what's driving all the weaknesses.
And we are less than 2 weeks away now from the election as the candidates make last-minute pitches to undecided voters, if there actually are any. We'll give you the latest on the race to the White House.
And still cracking open a Coke. Coca-Cola raising its outlook as consumers swallow higher prices. We'll talk to the company's CFO, John Murphy, in just a couple of minutes. But let's take a check on these markets. Of course, like Matt said, 30 minutes out from that cash open, still a down day, on track for a third straight day of losses for the S&P 500, currently off about 0.3%. Big tech dragging us lower. The Nasdaq 100 off about 0.5%. As we keep saying, Tesla reports after the bell, the first of really the big tech names to come forth. It'll be fascinating. Then you take a look at the bond market. That sell-off accelerating. The 10-year Treasury yield currently trading at 4.25, higher by about 4 basis points, Matt.
All right, so we have down arrows, but earnings season has been pretty good so far. Joining us to talk more about it is Kate Moore, head of Thematic Strategy for Blackrock's Global Allocation Investment Team. Kate, welcome to the set. Thanks for joining us.
Yeah, thanks for having me.
Our Katie, was talking about how companies who have done well have really been rewarded by this market, up, I think, 1.7%. What's your take on, obviously it's been small, but the amount of earnings that we've seen so far?
I think the earnings are coming in strong. I mean, not exceptional, but I would say strong. And we all know this. We had a bar lowering event over the last couple of months going into the reporting. So I love what's coming out so far. We all know that next week obviously is the big week. But the problem we have is there's a little bit of a sentiment overhang going into the U.S. election. I think the willingness to take huge risk, if there's some uncertainty into the future, is very, very low right now. Investors in general keeping their cards close to their vest. And I don't know that we're going to see the outsized moves, even if companies really beat and raise, that we might have seen in previous quarters.
Well, I'm glad you brought us to the election because it's basically all we can talk about at this point. And we've been asking guests all morning, when it's election night, of course, when you're watching your screen, your eyes twitching a little bit, what asset class, what line will you be watching?
I'm going to be watching S&P futures. I think this is going to be the one. What happens in terms of overall equity risk is going to be the most important sentiment indicator. And here I'm going to say something a little controversial.
Go off.
Which is that I think regardless of where the election might be going, like, I don't know that we're going to know on election night or even the next morning. I suspect there's going to be a little bit more of a more risk-on trade because the fundamentals look pretty good. The macro has stabilized and financial conditions are easing. We have this great backdrop for risk assets, and yet everyone is in this tight holding pattern as they're worried about what the election outcome might be. It's a bit of an excuse, and I suggest that like we might see up or up.
I was going to say, basically, stocks ripping either way. You didn't name sectors in there. And how much does either candidate matter for different sectors, given the differences they have?
Okay, so every week we have a different theme at Blackrock in terms of the daily global meeting. I happen to be hosting it, the global meeting this week. And the question I've been asking everyone is, what do you think is the most election-proof sector, trade, asset idea? And everyone has to vote on this, and different traders and investors opine on it every morning. And here's what we're coming out
Blackrock, the democracy.
Yeah, and here's what we're coming out on. There are a couple areas where, especially in the equity market, that may be policy insensitive or less policy sensitive. The AI and tech side, which people love to hate on given its leadership and the power behind that move year to date, actually is likely to do well regardless of who takes the White House and what the composition of Congress looks like. We're also going to see, and I know this has been a discussion point, America First trades do well. That's, I think, the case under either a Republican or a Democratic administration. And companies that supply, or at least can help to create a more domestic supply chain, will be in good shape. Another area I think that's going to be really important are kind of regional bets. We can talk about that as well. We continue to like India. We've seen a little bit of a sell-off as people have rotated into China more recently. But I think that's a region that U.S. and global investors will take a good look at after the election.
Before we get overseas, let's just focus in a little bit more on America, because I'm getting pretty bullish vibes from you, and it's reminding me of
the 15.
We had an interview with Brian Moynihan last night.
Yes.
Right? Heidi Stroud-Watts sat down with the Bank of America CEO, and he sounded also like he's a little worried that this economy could be running hot. He doesn't want the Fed to cut too much.
That's right.
He said, which, you know, he says no landing. That means they're going to have to keep worrying about inflation. What do you think about that view?
Well, I think there's a big gap between what's happening on the ground and the narrative. And that narrative that's just been in the media and the narrative that has been propagated by both parties, because everyone's talking about how they will change things, instead of acknowledging the fact that the economy actually is in pretty solid shape. We're running between 2 and 3% GDP growth for the second and third quarters. Like, that's pretty robust when you think how long this cycle has been, at a time when, you know, inflation is coming down. We're not like in a deflation environment, but disinflation looks strong. Labor market looks solid. There's not mass layoffs. I mean, we're in a pretty good backdrop, and it should be supportive of consumer spending and consumption next year. But that's not what's grabbing headlines, and that certainly is not what gets people to rallies.
Let's talk about, of course, the economy in the context of earnings, because we'll be speaking to the CFO of Coca-Cola at about 10:30. And it's interesting. You have this narrative out there, of course, that consumers are strapped, they're stretched, et cetera. Coca-Cola actually was able to raise prices, and that helped them do pretty well on earnings, even though their volume went down. And I wonder, I mean, just looking broadly, how much pricing power do companies actually still have?
Well, this is one of my big questions as we go through earnings this quarter, because we've had companies tell us they've had good pricing power. They've been able to continue to, you know, retain good revenue trajectories even after they've done that. Coca-Cola, not just the only example. So I'm going to be listening for that. But I think really critically important is that if you have a brand, if you have a specific product that consumers feel is essential or a big part of their own identity, or is something that they don't want to live without, you do really well. You do really well. And if you are something that is commoditized, you know, consumers are going to be more value oriented. So remember what happened in the second quarter? Everyone was like wringing their hands and stressed out because a bunch of companies said the consumer has become more value oriented. Can we remember that pre-pandemic, that was exactly how the consumers behaved? And so, you know, I think we're just going back to a normal environment where strong brands, strong products will continue to take up wallet share, and everything else, you know, you've got to offer good value.
So, hang on. Is Diet Coke a thing for you?
Absolutely.
Really?
Yeah, like a 2 p.m. Diet Coke.
You can't live without it?
I mean, I'll live. I just won't be happy.
Interesting.
You learn something new every day. Anyways, curveball, Kate, because this morning you had, or overnight, you had Kamala Harris really pulling something out of the Democratic Party platform that a lot of my sources have been waiting for her to pull out, which is that $15 minimum wage. First of all, it's probably not going to happen.
I thought you were going to say salt tax.
Oh, no. But, you know, the $15 minimum wage, even this direction of travel for wages being higher, you see all the unions as well kind of getting more of what they want at this juncture.
Yeah.
What does that mean for corporate America? On one hand, you have more money in the pocketbooks, right, to spend. But on the other hand, what does it mean for margins?
Well, look, we know this trend of investing more in technology and trying to reduce your total cost of labor has been in place for multiple years. Pre-pandemic, accelerated during the pandemic. The technology we all use to order food and everything, I think, will continue to be a core part of the consumer experience. So I expect that companies across industries are going to try and manage their labor costs. And even within an industry, we look really closely at, you know, the labor costs or the total labor contribution to sales. And I think those companies that are able to contain it and can maintain and expand their margins will actually get a premium relative to their peers. So this is not just about minimum wage. This is about, you know, controlling the overall labor cost, which includes healthcare, insurance, and everything else.
All right, Kate, it is always great to speak with you. Really appreciate you stopping by the studio this morning.
Thank you.
That, of course, is Kate Moore of Blackrock. Now, coming up, we'll take a look at some of the biggest market movers on the day, and surprise, they're all related to earnings. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. North Korean leader Kim Jong-un was seen in a photo inspecting strategic missile bases and ordered the military to be ready to strike a counterblow against the country's enemies at any time. The image was released by state media just weeks before the U.S. election and comes after South Korea reported that troops from North Korea had been sent to Russia to support its war in Ukraine. So I guess pay attention. Bloomberg has learned that the UK chip company ARM is canceling a vital licensing agreement for its longtime partner Qualcomm. The license in question allows Qualcomm to design chips based on ARM architecture. If the cancellation goes through, Qualcomm may have to stop selling products that account for most of its $39 billion revenue. And I believe they have 60 days to deal with this. Former President Barack Obama was joined by Eminem, Slim Shady, Marshall Mathers on the campaign trail in Michigan, with both men supporting the vice president's bid to win the election. Former President Trump, meanwhile, criticized Obama at a rally in North Carolina where he's trying to capitalize on the weak, or I guess perception of weak support among Latinos for Kamala Harris. Sonali?
Let's take a look at some of the stocks that are moving this morning as well, because we had a ton of earnings here, and it's been a funny trade here. You have AT&T, for example. They, I believe, missed, you said, on the top line, but they beat on earnings. You had them initially move lower, but they are now up more than 2.5%. And also interesting, guys, I'm watching a lot of the consumer names as well, because Starbucks is not doing quite as bad as it was earlier today after erasing the idea of guidance for the entirety of next year. So now only down about 0.5%. But Coca-Cola getting punished.
Yeah, let's talk about that. That's really interesting because they raised their outlook. And again, the price to volume mix, I think it's such an interesting moment. Of course, they were able to raise prices, but volume actually declined. There's not a lot of companies that can get away with pricing power at this point in the economic cycle. But as Kate Moore was just telling us, I mean, if you have an established brand, that certainly goes a long way.
Also, it starts at a pretty low base, right? I mean, I don't know how much a Coke costs. I don't drink soda.
I get it free upstairs.
Okay, but if you were to go to a supermarket and buy a Coke, you're not paying an arm and a leg for that.
That's true.
So
you
they
could say
can
the same, you
raise
could
prices.
say the same about Starbucks, but it is pretty expensive.
So Starbucks is mad expensive.
I know.
I'm guessing you can get a 12-pack of Coke for one venti latte.
I buy a grande cold brew every single morning. It costs like $5.70-something.
So I think, you know, when I heard
half a salad.
It's in my budget.
When I heard the Starbucks news, I thought the market would just take this as expected, because they brought in Brian Nickel in order to fix something that's broken. He obviously hasn't fixed it in the last
added
$2
$9 billion.
That's exactly right. I mean, you think about that huge run-up. It was more, I think, of a comeback to reality moment that, oh, right, he needs more than a couple months to actually right the ship here.
But, and any new CEO is going to say, you know what? I'm going to throw out the kitchen sink right now. Let's put our worst numbers forward.
Speaking of, that is kind of what Boeing did, too, isn't it? They basically, Kelly Ortberg came out and said, we're going to have a really tough roadblocks ahead of us before we can get to the other side, and then we will be your grand American treasure once again.
Yeah, of course, a long road there. And still, you think about more rocks ahead of them. Think about the union vote tonight. It's going to be fascinating to see what happens there. Boeing shares down about 1%. Now, coming up, Bloomberg New Economy Forum at B20 is in full swing in Brazil. We'll take you there for all the highlights. This is Bloomberg.
Business and government leaders gathering in Sao Paulo this week for the Bloomberg New Economy at B20. They'll discuss growing tensions over trade barriers, environmental upheaval, and global security. Joining us now from Sao Paulo, Brazil, is Bloomberg's editor-in-chief, John Micklethwait. John, great to have you here. I hear you're going to be sitting down with Bill Gates a little bit later. And one of the things that we've been talking about a lot, the best performing stock on the S&P is an operator of nuclear energy plants. Bill Gates is really a pioneer in, I guess, the second wave of nuclear. Are you going to talk to him about it?
Yes, I was going to ask him about that. He's done this State of the Transition report, which is kind of interesting because what he argues in it is that he thinks that climate technology, broadly defined, is in exactly the same position as he thought vaccines and medicine sort of technology broadly was back in 2000 when he started kind of giving money away. And his argument is that actually we're on the tipping point, that things are going to change. And obviously nuclear is one of the things he's interested in, but it's also things like green hydrogen and grids. And it's an interesting argument because it would seem to imply that business and technology are ready for a much more kind of climate-friendly economy, but rather obviously governments are not.
Well, to that end as well, as you guys gather in Sao Paulo, John, you have both public officials as well as the private sector joining together to solve a lot of these problems. And when you think about the AI revolution and the energy needed for it, I hear over and over again when I go out reporting that a lot of this energy cannot come out of the United States. There's simply just not enough ways to tap into different resources. How is that conversation playing out where you are?
Well, it's quite interesting. Brazil has lots of ups and downs at the moment, but one huge thing is I think 97% of its energy comes from renewable sources. So it is ahead, sorry, 93%, I think. So it is way ahead of most other places. It's also, famously the area where you've got the rainforest and you've got all the places which are most under threat. But it is ahead in this respect. And I think that makes it quite it comes at it from a completely different angle to the way that, I don't know, Texas comes at it. It's looking at it almost explicitly from the point of view that renewables are the future and that the whole kind of country and indeed the countryside in Brazil depends on that working. So it's a sort of more optimistic, but also with the very obvious fact that there's a very visible element of all the things that are wrong with climate in Brazil to look at too. So it's a nice kind of counterpoint. And in general, the government is making much more warm noises about it. You had Bolsonaro was less enthusiastic about these things. The new government is very enthusiastic about them.
And John, I'd like to talk about the forum itself. Of course, you're at the Bloomberg New Economy Forum. You explained a little bit why you're in Brazil, why it's being held in Brazil. What have been some of the highlights so far?
Well, it's only just begun, but I think the most interesting things so far have been the fact that there's I think Brazil is actually at quite an interesting point, and you're getting that quite a lot, not just from Brazilians trying to promote what's happening here, but also from all the foreign investors are here. I mean, on the one hand, you look at the actual underlying numbers for Brazil at the moment, they're not bad at all, they're very good. You've got kind of the economy's growing, the net foreign creditor, and a whole series of things that you would expect would bring people to Brazil, and yet there hasn't been an IPO for, I think, 3 years. So there's an element whereby money is beginning to look interested about it, but not actually coming that far. And talking to a government official yesterday, he said the whole problem is the narrative. If you look at the numbers, people say, oh, that's quite an interesting looking large economy, until you mention the word Brazil, and then people have these memories of bad things that have happened to them in the context of investing here.
John,
and the other huge thing about being here is you really notice the strength of Brazilian companies, these things which have kept on going throughout all the turbulence of Brazil and are now beginning to look more outward. Sorry.
Oh, no, I was going to ask you, this conference also dovetails with the World Bank, IMF World meetings this week. And of course, we had the news that the IMF lowered their global growth projections, but they did not do so evenly, with the U.S. actually being upgraded. How is that conversation playing out around you? Worries about global growth?
Well, the US sort of hangs over everything at the moment in two different and very contradictory ways, I think. On the one hand, on politics, everyone is looking with great trepidation towards what's happening in the election and the possible ramifications, not least if you end up with Trump and tariffs. That would have a pretty dramatic effect on Latin America. On the other side, there is a real appreciation that the American economy is the one that is the most vibrant in the world. You've just seen those numbers, and I'm going to get it slightly wrong, but it basically says that America is now close, I just think, gone past over half the G7 economies. So it's gone past Europe in a much more dramatic way than many people thought. So you have this very weird thing where people look at America and they see dysfunction on the political side, but amazing vibrancy in terms of companies, in terms of business, and in terms of the economy.
All right, John, we have to leave it there. Really appreciate you taking the time to speak with us. That, of course, is Bloomberg Editor-in-Chief John Micklethwait joining us from Sao Paulo. And, of course, you can continue to follow all of the events at the Bloomberg New Economy Forum at B20 throughout the day by typing Live Go into your terminal, including our conversations with U.S. Trade Representative Catherine Tai and Bill Gates. But it's time now for Social Climbers. These are the companies making waves this morning. And first up, Facebook parent Meta is banning accounts that are used to track celebrities' private jets, including the jet owned by CEO Mark Zuckerberg. Meta said the move meant to mitigate the risk of physical harm. And we also have the iconic RV company Winnebago set to have its worst day in 2 years after it missed profit expectations by a wide margin. The CEO said that the industry faces sluggish retail demand and high inventory carrying costs. You can see shares currently down about 5.5%. We also have Denny's slimming down. The 24-hour breakfast chain announcing it will close 150 underperforming stores over the next year and slash its menu as diners cut back on spending. The company said that more adults are ordering from the kids menu to save money. You can follow all the latest company buzz on TRE and Go on your Bloomberg terminal. A quick check on markets here, of course, looking at a third day of losses on the S&P 500. Those losses accelerating right now on the big benchmark, on the NASDAQ 100 as well. The bond market holding its losses as well, yields up about 4 basis points. Now coming up, Coca-Cola stock looking a little flat after sales volume in the third quarter disappoints. We'll speak to John Murphy. He is the CFO of Coca-Cola next. This is Bloomberg. All right, we're keeping an eye on Coca-Cola this morning because the soft beverage giant raised its outlook thanks to continued strong sales. Stock a little bit lower right now because that boost overshadowed by an unexpected decline in unit case volume in the third quarter. Joining us now to unpack is John Murphy. He is the CFO of Coca-Cola, and I'm so excited to talk about this. Of course, we have such a focus on the economy right now, and I think this is a really interesting sign of the time. So we're going to talk about price. We're going to talk about volume. Let's start with volume because your total unit case volume down about 1% in the quarter. What levers do you have to pull? How do you boost volume at this juncture?
So we did have a decline in the quarter, but I'd highlight the decline was primarily driven by some anomalous factors in July. Sequentially, we improved through the quarter, And in this particular quarter, thanks to our developed economies, we came out towards the end of the quarter in pretty good shape. And as we go forward, the name of the game is to get back to the more balanced growth equation that we've enjoyed in the last few years, and that is getting the developing emerging economies back to where they had been. And we expect to see that happening throughout the next 6 to 9 months.
And definitely want to get to the international view, but let's talk a little bit about pricing here, because your price mix, this is the prices that you charge across a range of your products. It increased 10% in the quarter, and I found that really interesting because not a lot of companies have pricing power left at this point. But how much more can your consumers handle when it comes to raising prices again?
So that price mix number is for sure, it's an interesting headline number. When you get underneath it, there's 3 factors. You've got normal pricing, about 3 to 4%. We have pricing that comes from some of our hyperinflationary environments, another 4% or so. And then in this particular quarter, we got the benefits from the mix impact of our more profitable markets performing better. So as we look to the next phase of the journey ahead, we see pricing moderating more in line with the CPI headlines here in the United States. And typically around the world, that's our approach also. We're also investing heavily in our brands to sustain their relevance. And through our various revenue growth strategies, offering both affordability and premium options to consumers for the occasions that they are seeking.
I wonder about your calorie-less drinks and how much the impact of Wegovy and Ozempic has had on the product mix. Are you selling more, just plain water or flavored seltzers and less of the more sugary drinks?
Well, we've had for the last number of years, we've seen trends towards lower zero-calorie products across the portfolio here in the US and elsewhere. We're not seeing a material impact yet in our data on Ozempic and similar types of medications. So our goal is to follow the consumer. We have a terrific innovation pipeline. We continue to invest, I think, ahead of the curve on the lower zero-calorie because around the world, that's what consumers are looking more for, and we're going to be there to provide them.
John, I want to double down on Katie's earlier question a little bit here because it looks like that's what investors are really latching on to. Because on first blush for a company, you would think that being able to raise prices as you have, despite everyone else not being able to, that would be a good thing. But the worries here rely around customers buying more, ultimately. So if you project out through the next year, how do you expect consumers to behave under this higher price scenario?
So at the highest level, we see continued consumer spending at the levels that we're seeing at the moment and growing pretty much in line with GDP expectations, which low single digit at the global level. I think what's really important, though, is to get underneath that, to understand your customer base at a much more granular level, and then to be able to apply the appropriate solutions that we have in our portfolio, offering affordability in where that's important. There's a lower income segment in the United States, for example, where we're offering a 1.25 litre package that's growing at double-digit rates. We have premium solutions too for the occasions where that works. So I think the name of the game is going to be adapting to those more granular segments, but at the highest level, we see continued resilience and continued growth in consumer spending around the world.
And John, I want to talk about the competitive landscape and potential M&A coming from Coca-Cola, because you think about this craze around healthier sodas. You think of Poppy, you think of Olipop, for example. Would Coca-Cola be open to buying one of those brands, partnering with one of those brands? What might that look like?
Yeah, we're always open to new opportunities that are out there. But right now, we have a portfolio of $28 billion brands that we think represents a tremendous amount of headroom for us over the next couple of years. So our primary focus today is to continue to invest and grow the brands that we own. And you always have to stay opportunistic. You always have to keep your eyes open. And if something more attractive than what we currently have comes along, we'll be open to look at it.
I wonder about the geopolitical risks out there, John. You know, we focus so much on interest rates and inflation, the labor market. And we cover, the war in Ukraine and the war in the Middle East as general news, but we don't hear much about them from business leaders. Until last night, we heard from a private equity company that they are concerned more about geopolitics than anything else. Do you see any effect of that on your business? Is it significant?
Well, operating in over 200 countries around the world, it would be hard to not have an implied effect from what's happening in the geopolitical world. And I think
that's why I ask you.
As James and I have highlighted, we have an all-weather approach to not just the geopolitical pieces, but the macroeconomics as well. And I think the name of the game is to stay very close to what's coming and to be in a position with our bottling partners around the world to adapt. So yes, if you look at the situation in the Ukraine, yes, it had an impact on the way we go to market and the markets we're in. But with our partners, we adapt, and we continue to see a global portfolio being the best one for us to be in.
And John, quickly, before we let you go, I am really curious about how you're thinking about marketing at this juncture. Of course, we had that long discussion about price to volume. How much, when it comes to your resources, are you dedicating to marketing spend?
So marketing is at the core of our ability to create value for both our consumers and for ourselves. And one of the lessons we've learned through COVID, post-COVID, and as we go into next year is to stay consistent, to stay investing behind your brands. I think what's important, though, is to understand the mix of the investments that you make. We're particularly keen to ensure on the marketing front that we're leveraging new technologies, we're leveraging new capabilities to stay close to consumers in the digital world, for example. And so it's a hugely important piece of our growth equation and will be for, I think, forever, actually.
John, great to get some time with you. Really appreciate it. John Murphy there, CFO at Coca-Cola. By the way, for more corporate finance coverage, you can subscribe to our weekly newsletter, Bloomberg's CFO Briefing. You can do that by going to bloomberg.com/newsletters. Now let's get a look at stocks moving at this hour. For that, we go back over to Abigail Doolittle. Abby, what do you see?
We will be taking a look at Coca-Cola in just a moment. It is on the bottom of this board, but let's start off with one of today's top stock stories, and that, of course, is McDonald's. Shares down nearly 5%, the worst day since March of 2020, as an E. coli breakout around their quarter pounders, affecting 49 people, at least 49 people in 10 states, one person dying in Colorado. The company saying it probably has something to do with one of their onion suppliers. Taking a look at Starbucks, these shares off the lows, a 7% drop for same-store sales. They've also suspended their 2025 guidance. It's pretty clear that the new CEO, Brian Niccol, well, he has his work cut out for him. One Wall Street analyst saying that this turnaround is going to take longer than expected. And then there is Coca-Cola, down nearly 2% or around 2%, as volumes did drop in the quarter that was most recently reported. Let's get to some good news, though, and one stock that is trading higher, AT&T, up 2.3%. They beat their earnings estimates for the second quarter, and the mobile subscriber number really beat quite a bit. This stock into today up 28%. So investors continuing to think that the good momentum is happening there. And then finally, Spirit Airlines, SAVE. It is up more than 100% over the last 3 days, or right around 100% over the last 3 days. And the most recent news after receiving new financing earlier this week, basically a lifeline, is that talks with Frontier are back on. This is the best stretch for this company, Sonali, not surprisingly, since it's been a public company back in 2011.
Abby, thank you so very much. Now, coming up, we're going to talk about a case for further economic integration between the U.S. and Mexico. Mexico's economy minister, Marcelo Ebrard, discusses how the two governments need to work together. This is Bloomberg.
It's time now for our daily Wall Street Week conversation. And with Mexico's new president in office and the U.S. election just weeks away, what does the future hold for economic integration between the two countries? David Weston spoke with Mexico's economy minister, Marcelo Ebrard, about improving trade and how both economies can benefit.
Well, we are extremely linked with the United States companies and market. So if you put tariffs on Mexico exports, for instance, those tariffs are going to translate in high prices for consumers in the United States. So I think we have a strong argument in order to reduce this possibility to have tariffs in our exports to the United States, because there are American companies exporting to the United States. So it doesn't make sense, really. It's extremely costly for the consumer in the United States. So I think that we can make a point here in order to avoid tariffs. We have a conversation about tariffs in 2019 because of the migration flows. And finally, we agreed to avoid the tariffs because the cost is extremely high for Mexico and the United States. Doesn't make sense. You don't solve anything with tariffs between us. Doesn't make sense because it's the same economy, practically.
You negotiated the USMCA on behalf of Mexico with the Trump administration. Has it been good for Mexico?
Extremely good, I think. Is it the best investment for Mexico is to strengthen the USMCA or expand in next years. And I think this point of view, you are going to find it between the Kamala Harris team in the same direction. I mean, it doesn't make sense to be against the USMCA because the best business between our countries ever. That's the reality.
From Mexico's point of view, how could it be improved? There's a review coming up in 2026. As you look forward to that review, what might Mexico want?
Well, we need to upgrade the USMCA, upgrade. It seems to be, what if we have a common vision about microchips, about pharmaceutical, about medical equipment, about several things, and we have a common plan to do it, to be more competitive in the next 5-6 years. It's not only about free trade, but it's about what can be done together in order to be more competitive, to success, not only to have tariffs in the short terms. We need to be more competitive. Think about, for instance, car industry. We need to work with them, really, in order to have a plan, not only a short time vision. And this is an upgrade in the treaty in order to have, okay, let's have a common agenda about the next 10 years. Energy, car industry, technology, why not?
And that was Mexico's economy minister speaking with David Weston, who joins us on set now. And David, this was a good reminder. I mean, we talk about Trump's trade policies all the time, but I feel like it's forgotten maybe that the USMCA was a Trump trade deal.
That is his trade policy. He fought hard for it. He got it. And by the way, Marcelo Ebrard, who we just talked with, was the negotiator for Mexico. He was the foreign minister then. So he negotiated with Donald Trump and his team over that deal. And so he thinks it was a really particularly good deal. He's the new economy minister under Claudia Sheinbaum. He's just started the first of this month. And he believes this integration has been so good that they're not going to be able to go back on it. You heard the discussion about tariffs. That was mainly in anticipation of possibly Donald Trump coming to office a second time. What's going to happen if he tries to impose tariffs? You heard him say it's bad for everybody, including the American people.
Certainly that chorus is getting louder. And it was interesting to hear him kind of directly address Kamala Harris as well, because a lot of countries right now are kind of skirting around the issue of the U.S. election. And so when you think about what's at stake, particularly with the nearshoring efforts that the U.S. is making, how would Kamala Harris versus Trump be viewed differently in his eyes?
Well, there'd be a lot less drama, I suspect, just from what we saw the first time with President Trump. He is a king of drama. Although, if you actually look at the trade policies he implemented, they weren't that different from what Joe Biden did. If you really look at it, whether it's China tariffs or whether it's what happened with Mexico.
The other way around. If you look at the policies that Biden initiated, they weren't different
Fair
from
enough.
Trump.
There wasn't that much of a difference.
Yeah.
It's exactly right. Biden didn't come in and change everything that Trump had done. Donald Trump has a history of saying very extreme things, but then often in the end negotiating something that isn't all that radical. At least that's my take on it.
Right.
And I think that's what Marcelo Ebrard is looking forward to with the USMCA. They'll have some talk about things, but he thinks they'll basically keep it in place.
All right, David Weston, great conversation. You can catch the full interview, of course, on Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg.
Election Day is less than 2 weeks away. Former President Donald Trump is heading to Georgia to campaign, while Vice President Kamala Harris is headed to Pennsylvania. Both candidates fighting for the last sliver of undecided voters, wherever they are. Here with us now is Bloomberg Balance of Power co-host Kayleigh Lines, putting in 24-hour days, essentially, until the polls. So, Kayleigh, what do they do in the final couple of weeks, the closing arguments, so to speak, to actually win this election? What are the most important kind of boots on the ground things that they can achieve?
Well, getting boots on the ground is going to be paramount, Matt, because at this point of the race, it's less about changing minds, as there are very few minds left to change, more about actually making people show up and vote for one of these candidates. So it's a turnout game at the end of the day, which is why you're seeing the Harris campaign specifically touting how much staff they have, 2,500 people with some 350 field offices, really investing in the ground game, where Donald Trump has outsourced a lot of his ground game and door knocking to outside operations, not directly affiliated with the campaign. So that's really going to be the bulk of it, and doing things that jive up voter enthusiasm, like, say, having powerful surrogates and even celebrities on the campaign trail. We're certainly seeing that this week, as former President Barack Obama has been campaigning in key swing states, Wisconsin yesterday, Georgia today, with Bruce Springsteen at his side. Donald Trump is getting ready to have a big rally at Madison Square Garden in New York this week. And that's really kind of an interesting place to deliver your closing message, as it's very unlikely he wins the state of New York. But you could say the same about Kamala Harris, who on Friday is going to Texas, a bright red state that she will lose in the presidential race. But she's going there to highlight abortion rights specifically, which is a key part of her closing argument.
Kayleigh, one thing I'm wondering a lot about, it's interesting to see, of course, you would expect all these boots on the ground with less than 2 weeks left. But I'm very curious about new policies, or old ones being resurfaced, rather. You think about Kamala Harris and this $15 minimum wage. That was right in the Democratic Party platform. But if you're an American that is feeling not great right now about the state of the economy and is still paying higher prices and maybe not thrilled about where their wages are today, does this extra promise really move the needle when it comes to the vote?
It could for some. What Kamala Harris likely was more seizing on was an opportunity to hit at Donald Trump, who dodged a question about a higher federal minimum wage when he was appearing at a staged visit to McDonald's in Pennsylvania over this weekend. She said in that interview with NBC that aired last night she would support 15. It was staged. The restaurant was closed, Matt. Highly choreographed. Secret Service had to clear the people actually getting the orders. This is a former president that we're talking about, so some of that does have to be involved. But this $15 minimum wage that Harris says she supports at a federal level might resonate with, say, some voters in some of the swing states that matter. In Wisconsin, Michigan, Pennsylvania, these crucial blue wall states, the minimum wage there is lower than $15. So that could be potentially appetizing for lower income or blue collar voters who are looking at their wages and maybe wanting a little bit more. I would point out, though, the vice president did say that's going to be up to Congress. Congress will need to be involved, and that's the case for most of the economic promises we've gotten from these candidates, including taxes, which Donald Trump was talking about yesterday, providing tax relief for purchases of cars, but only American-made cars.
That's true, and that's why the investors that we speak to are so focused on those down ballot races. But Kayleigh, you made the point that this is a turnout game at the end of the day, and we probably should talk about the fact that you already have somewhere north of 15 million Americans that have already voted.
Yeah, the turnout has been pretty incredible. You're seeing it in some of these key swing states in North Carolina and Georgia. More than 1 million people have voted. Wisconsin was seeing serious delays in voting yesterday in its first day of early voting because the turnout was so high. And what's really been interesting is we're starting to see in the data, including in a state like Nevada, Republicans are showing up more early than they did in 2020. Remember, in 2020, Donald Trump was very much casting doubt on the efficacy, the safety of voting by mail, saying everyone should vote in person. While his messaging has been more mixed on that, the RNC has really been trying to drive out the early vote. And there is some signals in states like Nevada that actually is working. Republicans are returning ballots at a higher rate than Democrats early at this point. So it's going to be interesting to watch, and it could affect the dynamics and the pace of results reporting on election night, because typically early voting does cater more to Democrats. It can lead to a mirage effect that Trump would be leading early, for example, relative to Harris. We saw that with Biden in 2020, but that may reverse this time if more Republicans are showing up early to vote. I will say anyone voting early are people whose minds are already made up.
All right, a great point. Kaylee Lyons, good luck the next 13 days. Let's take a look at markets right now. That sell-off continuing. Consumer discretionary stocks leading the decline. Of course, a lot of that coming down to McDonald's. Now, coming up tomorrow on Open Interest, Drew Livingstone of Citi, as well as the CEO of Serve Robotics, join us. This is Bloomberg.